So today I'm going to talk about crypto options, why they deserve to have a place in your portfolio. So in every financial market, contracts form the basis of things. Contracts are legally binding agreements designed to serve specific purposes and needs. In financial markets, contracts are crafted to make a profit and are also known as financial instruments, abstract tools made to generate profit. One such instrument that's been developed to make a profit is options. As with other derivatives, options contracts track the underlying asset's price, that is, its value is dependent largely on other instruments' price, either cash or derivatives. An option is a contract that empowers a party to buy or sell a financial instrument at a predetermined price on or before a predetermined date. So are there options in cryptocurrency? So in their bid to become mainstream, cryptocurrencies are adopting several financial processes and instruments, with options being one of the latest instruments to be integrated into crypto ecosystem. Investors in the crypto space like options because they can serve as a hedge against existing risk and provide greater market exposure, diversifying one's portfolio and enabling increased profit margins. Apart from this, options also allow traders to use a small amount of money to control a larger position value, which is leverage. So as only a small amount is involved, the return of interest on options trading is much higher than that of other types of trading. Yes, there are options in cryptocurrency, and this sector of the market has experienced tremendous growth in the past few years, with outstanding contracts racking up billions of dollars as a whole. So what are crypto options? So crypto options gives a person the privilege, not obligation, to buy or sell the underlying cryptocurrency at a preset price on or before the expiration date after a premium is purchased. They are used by options traders for speculation, potential profit if the asset moves in your direction, or by investors for hedging. As we know, volatility is rife in the crypto market, making crypto options a popular choice for investors. Currently, the most popular crypto options are Bitcoin options and Ethereum options. Before we proceed, a couple of definitions are in order. Premium: the amount a person pays to secure the rights provided by the contract. Strike: the price at which a person has the right to buy the underlying asset for a call option, or the price at which a person has the right to sell the underlying asset for a put option. So call and put options. So there are two types of options contracts, which are the calls and puts. So call options: when it comes to call options, you can either buy call options or sell call options. So buying call options: when you buy a call option, you are essentially buying an underlying asset at a particular predetermined price, regardless of the market price before or at the contract's expiration. When speculating in the financial market, you can purchase a call option when you believe the market price at the contract expiration will be higher than the strike price. In short, you anticipate that the value of the options will increase. The more its value increases, the more you will earn. Buying call options: for example, Shaw purchases an Ethereum call option that will expire after a week with a premium of 25 USDT and a strike price of $3,000. When the price of ETH moves from 3,000 to 3,200, he may decide to close his position before the validity period elapses, and his gross profit will be $175. That is 3,200 minus 3,000 minus $25 over market price at execution minus strike price minus premium. Selling call options. So on the other hand, call options selling, which is naked call, is carried out when a trader expects the price of the underlying wallet to remain flat or move lower. Selling call options. Example: given the example above, as long as the price at expiry does not go below the strike price of 3,000 and buyer does not exercise the contract, you collect the full premium of 25 USDT. A call option entitles you to buy an underlying asset at a particular predetermined price regardless of the market price before or at the contract's expiration. So put options. Put options allows you to sell the underlying asset at a predetermined price before or at the expiration of the contract, regardless of the market price at that time. Buying put options. So similar to calls, you can buy put options or sell put options. When you buy a put option, you are essentially selling the underlying asset at a predetermined price before or at the expiration of the contract, regardless of the market price at that time. When trying to secure the gains of minting or investing, a person could enter a put option contract to ensure the asset retains substantial value. A speculator could also purchase a put option if they believe the price of the underlying asset class would be lower than the strike price in order to make a profit by repurchasing it at a lower price than the one at which they bought it. Buying put options. Example: take the example of Chris, who had 100 BTC. When the price of 1 BTC was 48,000, as she expected its price to fall, she bought a put option from a crypto exchange that gave her the right to sell her asset at a strike price of 45,000 after 2 weeks. When the price of BTC grew up to 40,000, Chris exercised her right and profited $5,000 as a result. Selling put options. On the other hand, put option selling, which is naked put, is carried out when the trader expects the price of the underlying asset to go up. To selling put options. Example: using the same example above, a trader who sells Chris the option is betting that the price of BTC would go up. If the price of 1 BT goes up to more than 48,000, example 50,000 at the date of expiry, the option will expire worthless and the seller will get to keep the full premium. So how crypto options work? As contracts, options usually involve two parties, a trader and an exchange. An option seller places a contract order on the crypto exchange with the expiry date and the strike price specified. Then a buyer is matched with the order by the exchange. To ensure fairness, the cost of the premium is determined by the amount of time remaining on a contract before its expiration, the volatility of the underlying asset, the market price of the underlying asset, and the interest rates. In the money versus at the money versus out of the money. So in the money is the abbreviation for in the money. This phrase is used when the price of an asset is in favor of the owner of the options contract. That is, the market price is higher than the strike price of a call option, or the current price is below the strike price of a put option. So the at the money stands for at the money. This means that the strike price and the current price are equal. OTM means out of the money. In the context of a call option, it indicates the strike price is higher than the market price. However, when it comes to a put option, out of the money means that the strike price is lower than the market price. Common crypto option strategies. So bull put spread. This is a strategy regularly used in trading options. As its name implies, the bull put spread strategy is used when the trader or speculator believes that the underlying asset will experience a slight price increase. So bull put spread can also be achieved with out of the money, that is selling a put option at a higher strike price and buying another put option at a lower strike price with the same date of expiration. The key here is that you want to sell the strike price and sell the higher strike and buy the lower strike. However, although the risks are fairly low, this strategy is not immune to risks. Potential loss will be the difference between the two strikes minus the credit received. If the asset is lower than the strike price at the expiration, both put options will expire in the money and a loss will be recorded. So bull put spread examples. For example, a crypto investor is bullish on Bitcoin, whose current price is 48,000. The investor sells a put option for a premium of 2,400 at the strike price of 48,000 with a 1 month date to expire in 1 month. Concurrently, he buys another put option for $800 with a strike price of 45,000 expiring in 1 month. The investor receives a net profit of $1,600. That is 2,400 minus $800 premium paid for the two options. This is called net credit strategy. If things go south and Bitcoin's price drops to between 45,000 and 48,000 at the date of expiry a month later, the investor will likely make a loss. If Bitcoin's price goes even more bearish and drops below 45,000, the investor will incur a max loss capped at 45,000 minus 48,000 minus plus 1,600 is equal to minus $1,400. So bear put spread. This is the inverse of the bull put strategy. When an investor feels moderately bearish on an asset, the bear put spread is the right way to go, as it reduces cost and risk while simultaneously offering the chance to profit. So to execute this strategy, you buy a buy put option and simultaneously purchase a sell put option with a lower strike price. Both contracts need to be of the same asset and same expiration date. So for example, if the asset is trading at around $65, you can buy a strike put at that price for around it for $5. This equals $500 as premium, while selling another put option that has a strike price of $60 at $3. This equals $300. Note that the two options are to be executed at the same time. It's ideal to place orders as a spread to do this. The net depth is $2 per spread. A premium of $200 is the maximum loss that can be recorded. If the price drops to $50, you get a gross spread of $5, while the net spread is $3. This equals $300. Iron Condor. This strategy makes use of 4 contracts, 2 puts a long and a short, and 2 calls, a long and a short. They all have 4 strike prices and the same expiration dates. It profits from low volatility, small moves in prices. Here's an example of how the way it works. Buy 1 call at $300, sell 1 call at $280 with $20 in between. Sell 1 put at $270 and buy 1 put at $250. That's $20 in between. So this is a chart of how an iron condor looks. So the maximum profit with the iron condor is the total premium received for opening the 4 options positions. In contrast, a loss is the difference between the long put and the short put strike prices, or the long call and short call strike prices. Adding commissions and reducing the loss by the net premium received gives the maximum loss. So American versus European style. So the American style options contract is a method where the execution of the contract can happen before the expiration date stated in the contract. In comparison, the European style options contract requires that the contract be settled only after the contract's expiration. Cash settled versus physically settled. A cash settled options contract is a procedure of settlement in which the contract is settled by the cash equivalent of the underlying asset upon execution if the contract is in their favor. But physically settled contracts are settlement styles in which the underlying asset is used to execute the contract. For example, if Sandra closes a call option position that allows her to buy $10 Litecoins at a strike price of $136 and the market price is $170, instead of receiving a credit of $240 as a gross profit. That is $170 minus $236 times 10. She is credited with amount of Litecoins the profit can buy, which is 2 Litecoins. To bracket $170 minus plus $170 is equals to $340. So crypto options versus stocks options. So in stock options trading, one contract is equivalent to 100 stocks. That's when the price of a stock goes up by $1, the investor profits $1 times 100 stocks, it goes to $100. However, when it comes to crypto options trading, using BTC as an example, one contract is equals to 1 BTC. So when BTC's price goes up by $1, the profit earned is $1 times 1 coin, which is $1. To get the same $100, an investor will have to buy 100 contracts or 100 BTC. Options versus futures. So these two financial derivatives are remarkably similar, as they both track underlying assets and allow people to speculate on them. They also allow traders to take long, which is called, or short, which is put option positions. However, their features differ slightly in their modes of operation. Let's see how. So an options contract allows you to buy an underlying asset at a price other than the current market price. It gives you the option of buying or selling the underlying price. However, in a futures contract, this move is an obligation, a duty that isn't based on the holder's discretion. This means that if the price moves against the directions of a futures contract, the position will be closed at the expiration date. As it's a type of smart contract, it can execute on its own. Compared to options contracts, futures contracts are high risk, high reward. Unlike options contracts, where the maximum potential loss is limited to the premium paid for the contract, in a futures contract, the loss depends on how much the price has moved away from the entry at the expiration date. The stakes are high with futures. Whilst there is potential to make a lot of money, you could potentially lose a lot of money as well. Options versus perpetual. Perpetual Futures contracts, or simply perpetuals, are contracts with no expiration date. They allow traders to close their position if they are gaining at any time. At times, their positions may be liquidated if the market moves away from the prediction as a result of the leverage used to open such positions. This means that all perpetual contracts are settled in cash, as there is no expiration date when they are physically settled. That is, all perpetual contracts are American style. Why to trade crypto options? So Bybit, which is ranked number 10 on CoinMarketCap for derivatives. Bybit officially added crypto options to its product list in May 2022. It currently carries BTC options. Deribit, this is the largest crypto options market by volume. It's a BTC ETH options market and only executes contracts at expiration. It settles options contracts in cash by crediting contract owners the cash equivalent of the underlying asset. It also offers up to 50 times leverage for option traders. For KES, this is another market in which to trade up BTC and ETH options. Unlike Deribit, it settles contracts physically, but it doesn't allow the settlement of contracts before execution dates. CME, the Chicago Mercantile Exchange, is the largest crypto futures exchange, but it also carries options contracts. It uses cash settlement and settles contracts only at expiration. Potential risks. Regardless of one's experience, skill, or luck, no one can predict future happenings accurately. There is always a risk involved. The leverage used in trading options contracts could lead to the loss of premium due to small changes in price movement. Sudden market moves are also to be expected whenever whales enter the market, posing a risk to traders. Fundamental changes could also affect the price of an underlying asset in shattering ways. A lawsuit, a scandal, a security breach, virtually anything could radically redirect price movement. Closing thoughts. The crypto financial space is relatively new, and complex instruments are just gaining a foothold in blockchain technology-backed assets. The depth of regulation is concrete proof of this assertion. However, we can't deny the potential that cryptocurrencies have in revolutionizing the financial space. Options trading is widely gaining popularity in the crypto ecosystem. With potentially high profit margins and calculated risk, consider adding crypto options to your portfolio for diversification.